will be eligible for the ETF promotion for the SPP handling fee waiver. So what's SPP? Share builder plan. It's actually like the regular savings plan that you might have heard of from the other financial institutions. All right. Okay, so today is actually a full event, right? So let me do a very short introduction. This is the program for the session. Right, so this is the AM program. So as you can see, we do have sharing from Mr. Jeff Howie as well as Mr. Paul Chew first. Then we do have lucky draw, and then we actually will move on to the two ETF issuers. Along the way, they do also have their own lucky draw too, first and second. All right. Then PM session, we do have, all right, continue with two more ETF issuers who will do their sharing. Also, same thing, we have two lucky draw along the way, interim. Then we have the panel discussion. All right, where after that, we will have a Kahoot as well as lucky draw, this lucky draw giveaway. So do note that our grand lucky draw prize is the iPad 10.9-inch Wi-Fi version, 128 GB. All right, so we do have a grand lucky draw top prize of an iPad. That will be also based on your lucky draw number, right? So I wish all of you all that is here early the best of luck, right? Maybe for the lucky draw session. For Kahoot games, there's also 5 prizes to be won, and this will be more of like those who get answered correctly as well as fastest fingers first. So together, so the one will be the top prize will be a Fitbit Versa smartwatch, as well as we also have a Tucker's Bluetooth speakerphone. Right, along with 3 other prizes that we do have for the Kahoot games. So do note that Kahoot games and the grand lucky draw, as well as the lucky draw along the way, will only be exclusively for those that have joined us in the physical event. Those that are online will not be eligible. All right. So if those that are joining us online want to participate, right, we do only invite you all to join us at the physical event for our future events as well. Okay. Okay, so I'll be passing the time to Jeff later to start, right? So we will let more people stream in. Correct. Currently, the time is 10:05. I believe because it's a Saturday morning, right? Everyone is having a slow start to the morning, right? Everyone is still waking up and starting their day. Not only for those that are here physically, but also online. So, with your hands, if you all have already grabbed your coffee, anyone already drink coffee already? Or wake up already? Yeah, can haven't wake up? Oh, still sleeping. Right, but so not to worry. The barista station, just to what I mentioned, is actually available all the way till 2 p.m. Right, if let's say along the way when I do the lucky draw along the sessions, suddenly feel very sleepy. Right, head out, get a cup of coffee, drink, and come back in. But do note that this auditorium space, no food and beverages allowed. This one is SGX regulation, right? I cannot overrun it. All right. So go outside, get a coffee for yourself, get a drink, right? You can put yourself up a bit and come back in and then enjoy the sessions with the speakers. All right. Okay. So we'll be starting very shortly. Let me just get a confirmation from my colleague. Right. All right, can I get the assistance from the IT side to on the mic also for outside? All right, okay, so I think those outside the auditorium can also hear me now. Right, so if you have already registered, right, do try to enter the auditorium. We will start in 2 minutes. All right, We'll start in 2 minutes at 10:10 sharp. Right, so do enter to get your seats that you prefer because we are expecting a full house. I believe most of the people that are joining us on the physical session, because there might be a queue at the registration. So of course there might be a flow in issue, some delay in the flowing in. So not to worry, but if you're already registered and enter the SGX area, do enter the SGX auditorium. If the SGX auditorium is full, you might need to enter the SGX Academy room instead. So that is our backup room for when our auditorium is full. Right. So if you are entering from outside, you can enter from the door on the right hand side that have more space on the right hand side. Right. So you can enter from the other side of the door to have more seats available for you. Okay. I think we do have quite a good turnout today. I'd like to thank everyone for coming in so early. Right. And I think most of y'all might have a hard time waking up. I have a hard time waking up myself. I had to reach here by 8:30. All right, so I went to buy breakfast for myself first at 8 o'clock at the first place. Okay, so without further ado, right, so to prevent me from rambling on, right, I will actually start the event. Our first speaker will be Mr. Jeff Howie, market strategist from SGX Group. All right, so he'll be sharing more about the future of ETF, the trends and innovations and opportunities. Right, so warm welcome for Mr. Jeff Howie.
Good morning, everyone. Thank you so much for coming along and joining us today at SGX. Real absolute pleasure to have you. There's a really great lineup of speakers. We have 4 of our ETF issuers who are here to engage with you, train, and have some fun. So hopefully you get the most out of this day for everyone who is physically here, and for everyone who is watching us digitally, very warm welcome to you as well. So I've been given a task of 5-10 minute opener just to discuss a little bit about what our ETF footprint is and how that might help you through today's list of speakers. As I said, it's a long billing, and I really want to, I guess, really share what really is our most exciting updates, what is our most exciting figures from the world of exchange-traded funds that really is, I guess, shaping the investment landscape, if you will. So I'm going to try and be a little bit bold as well and dive into the numbers that matter, and of course the economic outlook that's guiding the investment strategies of every investor. So firstly, the global ETF market has experienced substantial growth since I think 1990 to 1992, around the time I was at university, was the same time we started ETFs globally. So they've been around for a good 30 years or so, more than 30 years, and have total asset under managements now in ETFs at 13 trillion. For context, globally, across the world, you've got 100 trillion of GDP, and you've got around 110 to 120 trillion of global market capitalization across the stock market. So you can see there's a pretty strong cornerstone of investors that are participating in global growth and global markets from the perspective or from the lens or from the footing of an exchange traded fund. Now, what this expansion really does, I think, reflect is increasing investor interest in economical access to diversified and accessible investment options across various asset classes. Economical, because before COVID, there was a lot of studies conducted that showed that ETF growth in terms of investor participation was very directly correlated with the reduction in fees of ETFs. That's your total management fees or total expense ratios. That was so much more competitive than the big mutual funds, the big hedge funds of the world. So I guess since the inception of Singapore's first ETF back in 2001, we've also witnessed a remarkable journey, which has been aligned with that demand for funds at a lower management fee. One of our pioneering ETFs, not our first, but one of our first, tracks the Straits Times Index, or the STI as we colloquially call it. that ETF has delivered a 6.4% annualized total return from its inception in April 2002 through to yesterday. Despite the recent challenges that have seen this return actually dip to 5.1%, that's an annualized total return of 5.1% since the end of 2019, investors who have been able to embrace dollar cost averaging have still been able to capture 80% of that total return since the end of 2019. So the growth of ETFs here, as I said, has been nothing short of impressive. Since the beginning of 2020, SGX has listed 20 new ETFs, and the combined asset under management of all our Singapore ETFs has more than doubled from 5 billion Sing dollars to 11 billion Sing dollars. And this growth, I think, is very much a clear indicator of the innovative drive of our ETF issuers like CSOP, Lion Global Investors, Nikko AM, and Phillip Capital Management, who have all been pivotal in this expansion. And as I said before here today, they're here to help educate, train, and have some fun. So ETFs don't just stand for engagement, training, and fun. They also stand for exchange traded funds, but they also stand for efficiency, transparency, and flexibility. They have really lived up to this by allowing investors to systematically add units to their positions during market volatility. For instance, it took 17 years for both SDI ETFs to reach a combined asset under management of 1 billion Sing dollars. We saw that combined asset under management reach $2 billion in the space of just 17 months across the market volatility we saw in 2020. Focusing on China, SGX is home to 10 China ETFs that track a wide range of China equity indices. Half of these are part of the Singapore China Singapore ETF link that are aligned with the sectors very relevant to China's multi-year economic policies. SGX also lists 2 ETFs tracking China fixed income, providing access to the not so easy to access onshore China bond markets. So China's economic outlook, it does remain cautiously optimistic. There is a big focus on long-term structural or strategic industrial policies that are very much aimed at rejuvenating domestic demand and also securing more upstream assets in their value chains. The country is also addressing the impact of its property market slowdown with fiscal consolidation frameworks, as we saw announced this week. And the property sector in China itself is expected to recover come 2026. So as I said, it's very important to take a very long-term structural multi-year approach when it comes to judging China economic policy and its impact on all the relevant parallel sectors. There's other ETFs listed here that track the United States, of course, Japan, Indonesia, Vietnam, India, and of course, a number of APAC regional facing indices that are tracked by the ETFs. And look, most ETFs look to track indices, and this is where the real innovation comes into it. And this is where a lot of excitement is in the next 10 years or so, because what we can do with indices is getting, particularly with generative AI, is getting more interesting by the day. Indices, they're all frequently rebalanced, and that allows for the inclusion of new constituents and the removal of those constituents that no longer meet the criteria or meet the bar. That ensures that all these indices, they remain reflective of the market. And this offers you as an investor a way to participate in market evolution over time. Taking exposure to evolution is really important. For instance, the STI Straits Times Index, its base date is back on 30th of December, 1966. That's when the STI was at the 100 level. That outdates most stocks here, well outdates most listed stocks. And it continues to be a reliable indicator, obviously, for the market's health. So whatever this STI composition looks like in, let's say, 2066, those two STI tracking ETFs will provide a means to participate in that journey. So the overall AUM of 11 Singapore billion dollars of the Singapore listed ETFs, it's not just equities and a few fixed income, as we mentioned before. It's diversified across a number of equities, REITs as well, fixed income, and of course, gold. Gold has proven its worth as a safe haven, with the SGX listed Spider Gold Shares ETF seeing a surge in trading turnover in the first half of this year and really cementing its place as a safe haven asset. So while the STI has kept pace with the regional APAC gauges since 2019, the gold ETF has actually doubled the performance of the STI and those regional gauges amid those challenges of the last 4.5 years. When you look at the distribution of AUM, which of course is very important for us as ETF portfolio investors, it's quite evenly distributed, presently balanced. When you take that 11 billion Sing dollars, you've got 39% of that 11 billion in equities, you have 8% in REITs, 40% in fixed income, and 13% in gold. And geographically, half of the relevant AUM is focused on Singapore, with the rest of the focused on the Asia Pacific region, with China obviously being the most largest component of that. So together, these Singapore-listed ETFs, they do offer investors, I guess, a gateway to participate in Asia's economic expansion, capture the opportunities in the pivotal sectors, and also those emerging themes. The emerging themes like green REITs, Asia electronic vehicles, and APAC financials as an asset class in itself. Retail investors now hold over a quarter of that 11 billion Sing dollars of AUM, and the SRS holders are increasing their ETF holdings. They've increased it from 170 million Sing dollars at the end of 2019 to nearly or around 500 million. I think Wei Chin said it was 501 million as of present. The avenues for ETF investment, they have broadened notably as well through advancements in fintech and the advent of robo-advisors. And robo-advisors like DBS Digi Portfolio, Stashaway, and Safe, along with regular saving plan providers such as DBS Investment Saver, OCBC Blue Chip Investment Plan, Philips Security Share Builder Plan, and of course the iFast RSP, they have collectively amassed close to 1 billion Sing dollars of assets under SGX listed ETFs. And look, education at the end of the day has also been a key enabler of ETF adoption among retail investors. The SGX Academy, along with partner brokers and platforms, and of course issuers, has consistently delivered education both online and physical, such as today. And look, while the year economically began with the lowest medium-term outlook for global growth that we've seen in decades, we are presently witnessing transformative economic forces. Manufacturing reshoring, AI and digital transformation, and a push for sustainability are creating new opportunities. A final word on the current state of economic forces that are really driving the adoption of these strategic industrial policies across the world is that in that adoption, countries are looking to capture more upstream value in value chains and also foster better digital and sustainable solutions. So combined, they all do offer new global policy paradigms that we can work with to navigate, build growth, and present a future that's more ripe for innovative investing strategies. So earlier this year, in January 2024, SGX did welcome our first active ETF, and that marked a significant milestone in this ETF journey. And that ETF manager has adopted AI solutions to generate alpha for unit holders. So in summary, look, ETFs, they're not merely theoretical concepts, as we all well know. They are tangible instruments that are actively shaping our financial markets. They provide investors with a practical approach to spread risk, tap into global trends, and invest in their economic future. as we continue to, I guess, to really maneuver through the complexities of the financial landscape at the moment, I think ETFs will undoubtedly assume somewhat of a pivotal role in steering us towards a market that is both, I guess, inclusive and also rich with opportunities. So let's together work to identify where the trends are, carefully assess all those opportunities, and really embrace the future of investing. So thanks very much and welcome, and look forward to joining you as we embark on this day. Thanks.
All right, thanks, Mr. Jeff Howie, on being the first speaker to introduce more about the event. Right, so once again, I'd like to introduce myself. I'm Huan Tzu. I'll be the MC for today. All right, so because I've been informed, right, so not only to not lose your bingo card, which is important for your lucky draw as well as your meal ticket later, the lost and found we have is at our Philip booth. Because what I've informed is that there's already someone that have lost your red handphone. Right, so I'm not sure why so fast. I haven't early in the morning, maybe you forget because you haven't drink coffee. Coffee is until 2 p.m. like I mentioned, right? Coffee break along the way, lucky draw, whichever. All right, so if you have already lost your items, look for our Philip booth for the lost and found. All right, so next we do have with us Mr. Paul Chew, who'll be sharing more. He's actually our head of a Philip research team. All right, so you share more about the macro guide for ETF, and maybe you can put hands together to welcome Mr. Paul Chew. Thank you.
Is the lucky draw, so I know I should stop by 11:15. So for today, I'm just going to run through just hopefully a helpful guide for you on the macro situation as you select your various ETFs out there, which are numerous. So that's the picture suggests whether you're bull or bear. Hopefully, this is just a compass that will give you a guide of what's going on around globally and some pointers that maybe can help you. As usual, we have the disclaimer. I know nobody reads, but let me just summarize for you. This is for education purpose. We rely on public sources. Do refer to your financial advisor because we do not know your investment objectives, and know this just for general circulation. Okay, in terms of the content, I'll just go through briefly how the ETFs have been performing. Give you a bit of flavor of the current economic conditions globally. So this is not Singapore-centric, this is a bit more global. And then I will just give you a bit of some views on very top-down basis, how the equity markets are, bonds, commodities, why we think ASEAN is an opportunity, and also with this some conclusions. Okay, and here I'll just run through the short and long-term performance. I will start off with the Singapore ETFs. Magnificent Seven, not by performance, and just disclaimer here, I'm thinking just about volume, because if you look at some of the ETFs, some hardly trade. You buy one ETF, some they probably call your house because no one buy, they know what you did because nobody buys those ETFs. But these are the most heavily traded ETFs, the highest volumes. If you notice, I'll just put the numbers on the right. This is based on since 2019, because I was just using pre-pandemic just as a reference point. And you notice that the best performing ETFs has been gold, obviously, among the locally listed ones. In the middle, of course, STI was another strong performer. Gold, you probably, from that 5.5 years, I think you probably 107, about 70 or 80% return. And you will notice that the ETFs in Singapore, just like the whole Singapore market, is very income-centric. So we have a lot of bonds, we have a lot of REITs, and these are the most heavily traded. If you subscribe to the IPO of Lion, no comment. I mean, yeah, that's the price there. But you notice that in the beginning, if you just move to your left of the screen, you notice that in the very beginning, all the bonds, all the income producing ETFs are just performing well against the STI. I won't use gold because gold. And then once the interest rates start to move, you have the pandemic, and growth started to come back, and then the STI started to outperform. Of course, the STI here is very heavy on banks, and so that's one of the reasons why they tend to outperform. If you move on to, okay, I have to go outside, I have to look at just the global, just to give you an asset allocation basis, equities, bonds, commodities. So if you have bought the red one, which is the world MSCI, then congrats, you no need to stock pick, no need to think of PE, no need to do so much work, like just buy everything. Then you probably 140% in that couple of years. You're not even have to refer to get any advice from someone like me, because you just buy everything and you probably outperform everyone. Of course, bonds did well. So in the beginning, before interest rates started to rise, when interest rates were still coming down, you notice the black line, bonds and equities was more or less in line. Then, of course, when the pandemic happened, the only thing is the volatility. So when you buy equities, of course, there's a lot of volatility, and you shake a lot of people out. Usually, people don't buy when it's low, nobody buy when it's high, right? And you buy DBS when it's $30, $17, nobody want to buy. So that is the worry that if you're going to ride on equities, that this is a roller coaster. Just be mindful of that. But in general, because it tracks global growth, so it tends to outperform. If you're into commodities, just be a bit more wary, because commodities have this thing called negative. I'll describe it later, but there is this thing called negative rollover yield, because of if commodities contango, you roll over, it's very expensive. So even though commodities, you think commodities is a way to play global growth, good luck to you, because you're on that green line. So probably equities is still the better way if you don't think economy is still going to grow, and that's the way to play it through equities rather than commodities. Then again, if you decide to buy equities and you bought US, again, you're the best asset allocator. No need to think, no need to stock pick which stock is better. You just buy the whole US market, and that did tremendously well. And of course, the yellow line is the world index, because that is largely US, so that pulled that up. Of course, not so good now if you have bought China. I think China actually did, if you look at the red line, actually China did outperform even the US. Sometimes you see the red line just pops up above the blue line. So sometimes China will outperform. But clearly, since when the trade war started, let's say 2017, 2018, you can see that China really, when this US was a bit more aggressive on China, then you notice China has started to underperform the US quite significantly, and even gone below the world. Because like I said, the orange line is the benchmark. So anything below it means that you should be buying the very least the benchmark. If you can't beat the benchmark, which is the world, then you're a big underperformer. So you can notice that China was actually quite a strong performer against the world, but once the trade war happened, then the pandemic happened, you notice the red line just totally collapsed. There's a huge de-rating, which is pretty obvious, but just to emphasize here. The one that we like, because it's never performed after 20 years, so hopefully one day, is the ASEAN market, because the ASEAN is gray, and then it's virtually flatline, and then we'll try and give some reasons why we think. Emerging market is another category that's very heavy on China, so that's why it's also kind of underperformed. We'll talk about China later. Then we'll just run through economic conditions and what's happening globally, just to give you a flavor. This is the best part. If you're an economist, you do this, just talk. I don't have to give any conclusion. Just keep on talking about how things here, how our conditions, but we'll try and give some value add and just give you some how can it help shape some of your decisions. But anyway, just to start off, just to give you some perspective how global growth has been going on, because this is a macro talk. So US growth has been stellar. So if you look at the blue line, so that's US growth. So US, of course, China was the darling. I mean, China growth was some obscene, like 25. I'm talking nominal, because this is the real, nominal pays the bills. I mean, real is for economists to talk about, but nominal is where you actually include inflation. That's the real growth, that's the amount of real money that comes out. So for that, China, of course, is overheated, 25% growth. But you notice it started to decelerate, and then even now, US has already outperformed China. On paper, you don't see it. You see in the newspapers, they talk about 2.8 because they take into account inflation. But if you talk about the real economy, that's the nominal growth. So China has clearly underperformed, and I'm not sure how to give a very bullish picture on China. I mean, I can't give up. But anyway, it's still going to be very bearish. I will discuss it later. But you notice that that's why the US market has done so well. We'll explain why too. Europe, I mean, Europe is Europe. I just go sideways. Then if you move on to, so this is quite an important chart because everyone, the US likes to bash China, but no, China accounts for around 30% of contribution. So what it means is that if the economy grows $1, 30 cents come from China. So if you want to press China down, then it's going to affect the whole economy. Of course, affect Asia even more, because this is basically contribution to GDP growth. So of course, China was the main. China almost 40%, almost half of all the growth in the world came from China at one point. But of course, that's not happening now. It's coming down. And now the one that's picking up the mantle or the pattern is actually US, which is the blue line. And Europe, Europe, that's what it does. I mean, just go sideways. Okay, then I'll just run very broadly, all the countries just to let you know what we think is happening. So for US growth, we think it's stalling. So first one, the most important to see where the US economy is growing is to look at US government spending. If you assume the US growing 6%, the deficit to GDP, that means the amount, in layman terms, the amount of money or growth the government is injecting into the economy is also 6%. So it's unprecedented now. So all the growth that's coming up virtually is coming from how much the government is spending. So for us, we see the deficit sliding down from very extreme levels. So that's why we worry too, because the government spending is still spent. I mean, it will kind of cap any recession, but at the same time, it is slowing. So the rate of change is coming down. If you look at all the nice jobs number that comes up from the US, almost 3/4 is government related. So what are the new jobs in the US is you work for civil servant. I'm not saying here, but let's hear you are working for either civil servant, you're working in the hospital, or you're working for social work, all government related, like almost 3/4 of it. So if you talk about real private sector, that is actually contracting quite sharply. So with that slowing, then we think the US economy will also be like slowing down. The US consumer is also moving sideways. Ignore the big spike and dump, because that one is the base effect. Because pandemic, it collapsed, and of course, when it reopened, everything went up. But it's just moving sideways. So that's why growth, because US consumer, US economy 70% is consumer. So that's also moving sideways. The other thing we worry about is that the US is under saving. So this is the roughly how much they save. So it's really low, about 4%. And because there's so much wealth now, the economy, the property is doing, reasonably well, but at least the stock market is doing well, so they're not saving enough. So if there is a spiral downwards, it could be quite fast, because if the US consumer wants to normalize their savings, so that means spend less. When you save means you're not going to spend, then it could actually cascade, the growth can cascade quite fast if they normalize the savings. What it means that they don't space, they have to save back what they didn't save in the past, and then that means they're going to spend less. So that's the root. And then corporates are also cautious. So this is one way we track corporate spending. This is spending on equipment and all that. So that's also coming down. So China, we think is also deflating. Sorry, I got no good news here, but so one of the reasons why China is deflating is China is very dependent on fixed asset investments. So if you look at this chart here, is as much as investments can be roads, infrastructure, property accumulated. So there's the blue line. So the problem is the beige line, which is the private sector. I think it's so bad that they stopped releasing the data the last few months. But anyway, what's happened is that the private sector is not investing. So all the investing is still coming from the SOE. And that in investments is a huge part of the economy. And okay, this is a difficult chart to read because you get this big zigzag in 2019 because they open and close. But if you just remove that, if you read the wording there, what it means is that China's retail sales now is 2%. Like Singapore actually, so which is pretty bad because they used to grow at almost 10%. So you can say that China retail sales is down from the pandemic onwards, is down probably 80%. So it's a sign of the real weakness of the whole US, the real consumer, because the consumer was supposed to be the one that bails out China. I'll run through. Okay, then the other thing, of course, property we know. The problem with property is not that it's creating NPLs or creating problem loans, but property was almost 30% of GDP. And once that collapsed, how are you going to feel that hole? Like consumer not spending, only 2%. So your only way is to export. So this is a chart of homes sold. It can be space or can be units. So you can see it's record lows and almost 30 months of decline. So why property is important, just to remind everyone, is that it's like all of us know when you buy property, you support the cement, the upstream, you support the cement sector, bricks, whatever. And it's not just the property itself, you support government land sales. And you also support the downstream, electrical goods. Less property means less electrical goods, less TV, fridges, and what. So this is a big hole that's going to gap. So it's going to be very hard for China to fill this hole because property is really collapsing and it's still collapsing. I'm not sure who's a speaker for China, but anyway. Okay, so the other thing is that, actually, my colleague. Yeah, okay. So the other thing is, deflation. I want to run through this. It's pretty obvious. So what is hot now in China is the red line. So everybody is rushing into bonds now. Yeah, there's a bull market in bonds now because everyone's so bearish. And of course, the hope is that the government is raising 20 and 50-year bonds, almost 200 billion. So everybody thought, no, the government going to raise that money and put into the economy. But no, they're going to probably put it into defense and AI. I mean, probably make AI so cheap like an EV car. So what it means is that there is not the money that's going to be raised. The worry is that it won't be injected into the economy. So as the title suggests, it's a lot of tough medicine. So I think they will not be coming in to do any big fiscal stimulus to the economy. So the downtrend that you see in China, we think is still going to persist. They will still do monetary, but it doesn't really matter, right? It's already so low, record lows in interest rates. So we are still, at least for me, we're still quite bearish on China. Of course, they are going to rely a lot on exports. But you know who you're going to export to? You know, Europe don't want your exports. Then who you're going to export your EV to? US not going to take it. EU not going to take it. I mean, you can sell to emerging countries, but they don't even have electricity in the house. You ask them to buy EV car, and so expensive. Who's going to buy? So that's why even exports, we think, is also going to be very troublesome for China. You might see in the very near term some good numbers for China because right now everyone is stocking up in the US because with the threat of Trump or with the threat of trade war, of higher tariffs. When you speak to any port operator or exporter, there's activity going on because everyone is loading up the inventory because they worry if once he comes in, there'll be immediate tariffs across the board. So everyone is just stocking up. So exports might do well in the near term. And as you can see from this chart, the China exports peaked in 2018. Then once Trump came in, then it just collapsed. Of course, there was a big bump in COVID. That's because COVID, everybody bought everything. So even China benefited. But so we think that even if they want to use exports as the driver, it's going to be quite troublesome. The benefit is actually ASEAN, because actually in a way, this China plus one kind of saved the ASEAN manufacturing sector because of that, now everybody have to manufacture in ASEAN, whether they like it or not. Okay, okay, so I'll move on to just very quickly Europe and also okay, so and also Japan. So for Europe, what we think is happening is there's going to be a global synchronized kind of easing. So before I go to the US, so we think the ECB has already cut once, so the ECB is already going to cut another time. So this is basically the blue line is basically the interest rates in Europe. It used to be negative, so you can imagine that you put money in and they have to pay them, but not for individuals. But right now we think it's coming down, so this could of course benefit some of the REITs in Europe, and it will of course benefit assets there. We also see cuts also coming to the UK. So UK inflation used to be 11%, come down to 2%. They still don't want to cut. I'm not sure why. They say that inflation not on a sustainable path, but I'm not sure. You just look at this, it really dropped so much. But I mean, you think also UK is going to cut together with the US. So it will kind of be very supportive for income producing assets like your bonds or even your REITs and so forth. And of course, there's this thing called Japan cutting rates, but we don't think so. So if you look at this chart, the problem for Japan has been inflation. So so the funny thing is that if you speak to a Japanese REIT, they hardly raise any rent, even though occupancy is 99 because they're not used to it. Then when are you going to raise 110? So this basically shows what happened in Japan is that inflation went up. So everyone thought they're going to raise rates, but like any good poker player, they got bluffed. So they didn't raise. But what they did was the whole currency collapsed. So the currency collapse is pretty severe in Japan. It's as bad as the Thai crisis. If you do, it's almost like 40% drop in the Japanese yen. And we think that yen is still going to come down. We doubt that they're going to raise rates because there's just too much. If you raise rates, they are already paying 5% of their interest to revenue. Then if they raise it, probably 30–40% of all the tax they collect have to go into paying interest. That's not sustainable. Then you're also going to hurt the banks a lot. So that's why we think they were taught like playing poker. And they say I'm going to raise rates, but we don't think it's going to happen. So we still think, especially when the yen just improved, just appreciated, that gives them more cover not to raise rates. So we still think that it's still the only thing they're going to do is, you notice that when the blue line went up, the red line immediately kind of dropped. So instead of raising rates, they just let the yen collapse. Okay, then I'll just move on to equities. So what we see equities in the near term. So for equities, I will focus more on the US since they're the biggest. So the worry for equities is of course the red line. So the red line is the PE for equities. So you notice that it's now trending about maybe 22–23 times. I blocked out that part because that is very volatile because those are really during the pandemic times. So the only good thing why you don't call it a bubble yet is because of the blue line. So there's still earnings growth in the US. So if you look at the big tech, your Magnificent Seven or FANG or whatever, their earnings is almost 50% in the first quarter. If you include NVIDIA, even if you exclude, it's still like 30% growth. So there is still support for this so-called extreme valuations because the blue line is still coming up. So even though valuations are at 20-year highs, if you look at the red line, there is still support. So it's not like going to the extremes like you see in 1999, 2001. But if you look on the longer term, so this is longer term. So what they like to do is now you take all the earnings the last 10 years because a lot of volatility, right? So if you take the long-term PE, which is the red line, of course the greatest bubble you had was in 1997. So we are not the greatest bubble yet, but almost the greatest bubble. So we're not there yet. So there is still room for it to climb. So there is still some valuation support for the S&P before you start shouting and say, oh, things are gone to the extreme, because the red line still hasn't really gone up to the high extremes. Obviously, it's still at very high levels. And the blue line is basically S&P. So even if you were to do a standard deviation, it's not that extreme even though people might say that the US is running ahead. There is valuation support because earnings actually has grown in line with it. So in the conclusion, it's just to say that the valuations that you see here is actually well supported by earnings. It's not just the 1999 bubble that you see on the left. Okay, this is a very technical thing, but we just run it through because in the end, you also want to know whether compared to bonds. So this is just to tell you, okay, but interest rates has run up so much. Is the stock market in the US overvalued? So they like to use this thing, equity risk premium. In a layman terms, what it means is that how much should I earn compared to bonds? So at the high, people were expecting 11%, but right now you're looking at 6%, which is the blue line. So I mean, this is more for if you want to go technical on it. So even that also, if you look at equities premium, that means how much return should I be getting? My expectations, at least, it is not that high. It's still 6. The average is 4. So again, on that note, when you compare to bonds, the US equities, it's not excessive. I mean, unless you get a big recession, which you can see from the beige columns. It's only when you get a big recession and everything that's collapse. Okay, then the other thing is that so the other thing, the other debate is if you're ETF, we always hear people want to buy value, which I think in the whole Singapore market is value. So of course I want to promote value, but when you look at this chart, it's kind of hard to promote value. But anyway, the red line is value stocks in the US, and the blue line is all the growth stocks, and of course the yellow is just S&P. So you will notice that after the .com bust, the value stocks outperformed. Because everyone lost so much money in growth, nobody want to go back in. Okay, so that's the only time, that's the time when value stocks tend to outperform, because the red line, right, outperform the whole market. Then when recession time, everybody drop. So that's the other thing. If you want to hide out, so some might say, you should hide in value stocks, but there's nowhere to hide. Everything just drops. So I'm not sure hide into what. So the best way is not to get to equities. If you look at this chart, if you want to kind of summarize it, that's why we say there's no value in being value. So you buy it when you think it will return, not as the way to kind of hedge out your risk. Then of course since then you will notice the value and growth names tend to move in line in 2012-13. But then from pandemic onwards, you notice growth stocks just went berserk. I mean, that's totally outperformed value, and that's mainly because of the whole tech, and also because the US growth has been exceptionally strong. So that kind of helps the US growth. The beige line is just recession. Again, if you hit recession, don't even come near equities. There's nothing to hedge out. Okay. Okay, sorry, let me just... Okay, so the other thing to note is that, of course, the expectations now is going to be a September rate cut. So this chart is a bit complicated, but we always show this chart because this chart means in December, where everyone was predicting, including me, obviously was wrong, but then after that, everyone started to raise their expectations in June. Then now they're bringing down the expectations of interest rates. So you don't look at the December 25, that one is more the Fed's forecast. But up to December, you notice that people are bringing down their expectations of interest. So this is important for REITs. So if you had this blue line forecast, you lost a lot of money because the interest rates expectations went up. So right now, the market thinks that you're going to have 2 rate cuts. Actually, even in Europe, even in US. So we think it's going to be, of course, positive for bonds and even REITs. And there's a 90% probability of a September rate cut, which we think not, but anyway, that's where. So there's a Fed meeting coming up on Monday. So you must have to watch whether Powell actually gives a hint at September, and he might be cornered because market already expect 90%. So he might be cornered and say that most likely he would do. He may not do it in July on Monday, but he might hint that there will be a rate cut in September. Then you of course you get the usual rally. And this one just to show you that green line, just to show you even the Fed believes that there'll be rate cut. So interest rates is now, let's say 5%. So even the Fed thinks they're going to be rate cut by 2025, at least 3 rate cuts. So rate cuts is almost a done deal. I mean, just that, of course, the market has been caught off guard so many times, so nobody there to bet on it. But just a reminder, interest rate cut doesn't mean the equities will rally. So you will notice the blue line is the interest rate. So when you have a big rate, sometimes when you have a big rate cut, it's because there's a recession. Then of course, the equity market will collapse too. I mean, if you look at the rate line. So it doesn't mean you rate cut. But I think this time around, because there is no tail spinning, no downward spiral in the US economy, we think a rate cut will actually kind of inflate the market. But the thing to watch, if there is a recession coming on, then rate cut also doesn't really help the equity markets. So it's not always that rate cuts is a positive sign and you go rush out and buy everything. Okay, I will just move on to elections, since it's a hot topic. So this chart is basically the betting chart. So the red one is, I don't look at the polls, because polls, no value, is who put the money, right? So this is where people bet. So people are betting about almost a 50+% odds that Trump will win. And then the blue line was Biden, now goes 0, of course. Now then you have Kamala, which is about 30+%. So if you're near term, it's important to monitor this, because there's still 3 more months to go for the US elections. 3 months is long. The last 1 month, you already had the debate, and then Biden's approval rating collapsed. You had the assassination attempt, Biden stepped down. Then you had Kamala coming out. That's 1 month. Imagine 3 months, you times 3. There's a lot of things could happen. So from here to now, a lot of things could happen. So that makes us worry that the market might go risk off. So that the equity market, especially US investors, might risk off, because there's this thing called a tax cut. Because if Trump is not there, then the Democrats might actually raise back the tax, or because there's this so-called tax cut that he did in 2017. It's going to end of 2025. So assuming Trump wins, I do not know. I mean, like buying numbers, I do not know, right? So, but 2025, if things are aligned, this is the bullish case for US equities. Before I go to the bearish case now, so the bullish case is that there'll be a permanent tax cut, because then when Trump there, he will of course extend. After all, the name of his is called the Trump tax cut. Of course, he's going to extend his name under his name, right? So then with Trump there, one bullish case is that there'll be more resolution, because right now the current trajectory isn't going anywhere. There's still conflicts. That's why he might resolve it. Then of course the Fed will cut rates. So there's a strong bullish case. And the fourth one is now the second wave of AI. The applications for AI spread from NVIDIA. I don't think so, but anyway, that it will spread to everybody, rush out and buy the handphone because there's AI. Not me, but anyway, other people maybe. But so that is the bull case for the US next year, tax cut and all that. But the thing to also take note that to pay for this tax cut, Trump has to go on a trade war. So Trump wants to raise tariffs on everyone. Anyone who bring in goods, they're going to raise. But it also means that people are going to react, right? The EU is not going to let you, okay, you're so nice, you need to raise my tariffs 10%. Obviously, they're going to react and also raise their tariffs on the US imports. So you worry of this scenario. The initial reaction would be positive, but you just worry that the second derivative is that there'll be trade war between US, Europe, between everyone. And then also do note that specific to the big tech, which is about 40% of the S&P, the EU has a plan to raise this global tax, which is 15%. They didn't do it yet because Trump coming, but if they do that, then all the big tech names are going to get hit because they used to don't pay tax. Right? Then now they're going to get hit by a global minimum of 15%. So if Trump starts this kick this ball, then there's repercussions too. So do take note and not be too overly bullish. I'm waiting for what time the lucky draw. Okay. Okay, then the next one is bonds. So technically, we like bonds. Long-term bonds isn't so attractive. If you're a chartist, you can draw lines very straight. Then you'll notice that bonds have actually broken out, which is the blue. Okay, so the bonds is the red line. So it is broken up from this super bull 40-year where, I wish I was a fixed income bond manager in this super bull. You just come to office and you don't do anything. Just come to office and then just ride the bull because bond prices just keep on running. Just make sure you come to office and you're okay. Yeah, but we worry that this bull, longer term, I think there's going to be upward trajectory in interest rates. I will explain why. But in the near term, technically, we think it's attractive. One of the things that worry us why bond yields won't drop back so low and then all the REITs will rally like superstar is because there is a lot of supply coming out in the US. So just to explain this chart, so this is the amount of bonds. So the Fed stimulated. So it's nice. I mean, it's nice to stimulate the economy. Everyone have a party, but somebody got to pay the bills, right? So how you pay the bills is that you have to issue bonds. So you notice that there's this big spike in bonds. So this is net issuance of debt to public. So this is the amount of debt that people from can be American citizens, Chinese. Chinese not buying anymore, or Russians. Obviously, Russians cannot buy. So all the American citizens have to go and buy all these US bonds or some friendly Europeans. But what we're just trying to show you is that pre-pandemic, on average, the net issuance every year was about 1.1 trillion. So this will jump to 2 trillion. That means there'll be new 1 trillion of bonds issued every year to fund the government because they're having a party, right? Somebody got to pay. So someone's got to pay the bill. 1 trillion, and it's not just 1 year. The problem is this is going to continue. So you need to find 1 trillion 1 year, 2 years. So this is going to pile up 3 trillion, 4 trillion. So who are these buyers? I have no idea. So that's why there's going to be a big spike. We worry that it's going to be a big spike in bonds, and that's why even if interest rates come down, it may not come down that much. And the other problem, one of the problems is that the US is on fiscal deficit. So it's an autopilot because in the US they have this thing called Social Security, where it's auto. That means if you are, I forgot the retirement age, but if you're above 60 something, you get like $2,000-3,000 because you contributed. It's auto until the final days. But so you're going to get, and as they age, so this is their own projection, and that's why this deficit is autopilot. So this amount of bonds issued is virtually a done deal. You cannot turn it unless you don't want to be president, or then you cannot bend that curve or that orange line. And the amount of revenue you collect it won't move much, especially Trump doesn't want to collect any more tax from corporates, or at least less. So that's why the amount of debt coming out is a worry, and that's going to cap interest rates. But near-term bonds look cheap. So we got this fancy fair value, but it's just an average. So if you look at bonds, okay, so that the red line is where the yields are. So if you want to do very simple a calculation of how much a bond should be worth, it's very simple. It doesn't mean it's accurate, right? Just simple. So what it means that you should take your inflation. Then of course you need some yield above of your inflation, right? Because you can't be if inflation 2%, you collect 2%, then what's the point? So you want some extra yield, then term premium, because if you're taking 10-year bonds, you want more because you're taking more risk. So as a result, very near term, it looks cheap because it's 2.6, but longer term, I think the fair value is about 4.5. These are for those people who specialize in bonds, otherwise you can just kind of ignore this. Okay, but anyway, I'll just quickly run through for commodities. So for commodities, of course, gold was a winner. Industrial metals recovering, but again, we're also not very bullish on industrial metals. So sorry, so this is the ETS for all the various types of commodities. The yellow one is gold. Then the second best performer is industrial metals. It can be aluminium, iron ore. That we're not very bullish because we think it's just being inflated because China needs to complete all these homes and can't be leaving them out there. So you still get this one last surge in demand, then we worry after that it will be weak. Then of course you got agri, which we think longer term is more attractive than the red one is the whole commodity complex. So and of course the black one is gold. Of course, of course you can buy oil, but always be wary of this negative roll yield. So basically what it means in very layman terms, so even though oil price might go up, you'll notice that if you buy into this ETN, you actually lose money. Of course, don't scold the issue because it's meant to be like that. Because there's this rollover yield where let's say you buy oil at $80, then you want to roll up because it ends, let's say, by tomorrow, because these are all short-term things, right? So you will end tomorrow, then because there's a contango or oil is higher, you end up buying 90. So imagine you sell 80, then you buy 90, like it's the opposite of making money, right? You sell low, then you buy high, but that's how it's structured. So it's very good for more tactical things. So that's why buying commodities through these instruments is a bit of can be an issue because of this rollover yield. So of course, gold, everyone's hot on gold. How to value gold, nobody knows, which is a good thing because it can be 5,000, 20,000. You also don't know, nobody knows how to value. So that's the good thing about it. Not like stocks you can value. Actually, but if you want to value gold in terms of just roughly as a percentage of world GDP, so gold price is the red line. So if you want to take a step and try to guess the value, so of course you got this gold-silver ratio that doesn't work now, but you'll notice that gold as a percentage of the whole economy is, I think it's 17 trillion now, the value of gold. It's already hitting quite extremes. So you're talking about the super bull that gold had in the 1970s. So again, not saying that gold, don't buy, don't have to complain or gold rally, but I'm just saying that it looks extreme because it's already 17 trillion, like how much more, like 30 trillion, the value of gold. So this gold above ground, sorry, just to let everyone know, it's not the gold in your jewelry and so forth. Of course, gold prices went up because China has been buying, but again, this is just a food for thought that if you want to do a valuation, it's very elevated. Of course, oil is the other thing everyone likes to play. Just talk about it since it's a talking point. Not that there's many instruments to buy, but we think oil near term is very well supplied because if you look at the blue line, that's the inventory, and it tends to correlate very well. So if inventory comes down, inventory goes up. Actually, it's the inverse. Goes up, then of course the price of oil will actually come down. It's a bit harder to comprehend because this thing is inverse. But in the medium term, it's very negative for oil because although Saudi Arabia cut, but the rest didn't cut. So US, so they actually sacrificed themselves. So nice of them. But you notice the numbers on the right that over the last 2 years, Saudi Arabia cut, they got spare capacity, but the rest didn't. US just ram, and the fragile five, which is your not so friendly neighbors like Iran, Iraq, Libya, they all keep on ramping. So in the medium term, there's a lot of oil in the market. also a lot of spare capacity because OPEC is actually holding back. So this is basically production of the US continuing to rise in the Fragile Five and Saudi Arabia, just for your reference. Because since you talk commodity, we have to talk about oil. But the one thing we like about oil is that if it comes down a lot, it's worth considering because there's a lot of event risks for oil. So you'll notice, okay, this is a copy from all the various media, but it's just something to note off is that oil can spike anytime because right now all the conflicts don't really affect, they don't really attack the oil facilities. So you notice that in 2019, there was an attack on Saudi. I forgot the name. Just slipped my mind the name, but there's this very big oil facility in Saudi Arabia, like probably 30% of the world's supply. So they didn't destroy it. Obviously they can, but if they did that, then the whole oil price would just spike up. Likewise, in 2019, they just damaged. They could have sunk it. I mean, come on, they just damaged. So nice and just to damage it. So they could actually sink some oil tankers. So what I'm saying is that if oil actually comes down to a certain level, there's a lot of hidden premium in terms of like event risk behind oil. And likewise, also, Ukraine can, if they want to, I mean, they can just damage a refinery and then oil price will just spike up too. So that's why we also thought that oil is another way to hedge out any risk, not just gold, because there are very specific geopolitical risks on oil. Then of course, the weirdest thing to do, the weirdest thing to do was when you, I'm just trying to read the article. The weirdest thing to do is when Ukraine, this one's not good for anything. This one is when you want to just buy aluminium cans, because what happened was that Ukraine went and destroyed Russia's nuclear radar system, which isn't good because then the Russian got to take the binoculars and see if there's any nuclear weapon. So this is not good for us because it doesn't alert them and it could actually trigger something unwarranted. So this is another thing. That's why, and of course, there's going to be a huge hurricane season coming up in the US. So that is also another why we think all could be one way to play, to hedge out apart from gold. Okay, the other one we like is agriculture, mainly because I use palm oil. I mean, because this is what we are more familiar with. But any formulation palm oil, you notice that after years of growing planted acreage, they can't grow anymore. So actually, supply is quite capped. And Malaysia, Indonesia are the two largest palm oil producers. So that has kept, and we think, and consumption always rises, but then supply is getting tight because of land and so forth. Okay, I will run this through quickly. So for us, we like ASEAN, not only because we are here, but also because valuations are at decade lows. So if you look from this chart, we like to go something contrarian. And behind the scenes, ASEAN has done well. If you look at just foreign reserves, but of course, mindful that a lot of it comes from Singapore. So actually, the balance sheet, in a way, you could say, of ASEAN has actually improved significantly. Likewise, again, investments coming into ASEAN, especially China Plus One, that we really think kind of save the whole ASEAN manufacturing ecosystem. Otherwise, everything would have just gone to China. So thank you, Trump. Next one will be, the problem for going into ASEAN is that the currencies. So if you look at this chart here, so the blue line is the Thai baht, the Asian financial crisis, everybody forgot. But anyway, you'll notice that the way the yen has dropped is as bad as the Thai baht. But of course, nobody talks about it. Because can't go there, although holiday destination, but not as good as during the Thai baht crisis. But so you notice that the Thai baht Japanese yen has collapsed a lot, and almost similar to Thai baht. And because of that, when the Asian currencies are down, no one buys Asian stocks. I mean, because everyone still looks at currencies, and that's why it's going to be hard for ASEAN to climb, because you're technically a competitor. China is your competitor, and with the yen dropping like that, of course, Chinese renminbi is also going to drop. So that's why it's going to be hard until we get some inflection point on Asian currencies. Of course, ASEAN equities, Asian equities is still going to drop. No thanks to the Japanese yen, although good for holiday, of course. So what we need is really the Chinese to consume. They are buying AI. I'm not sure why, but no, they're spending all the money on AI. So the problem is that if China were to consume like a normal country, you actually can inject 3 trillion into the world economy, which is a lot. The whole world is probably 100 trillion. So you could add. So this is the thing that we are hoping for, but it's not going to happen. I mean, you can just look up the sky and just hope, but it's not going to happen. So this chart basically shows the consumption as a percentage of GDP. So China consumers under-consume, they're only like 40%. US, of course, the extreme. But even if you just push it up to Indonesia level, you can actually stimulate global economy. Until that happens, so of course, I'm not trying to bring this up just for trivial, but just something to monitor. The big catalyst for whole Asia is if China really, the consumer consumes, not raise 200 billion and spend on AI again. Sorry, I keep talking about this. Yeah. So any final word for those? So this is more investment talk now. So why invest? So if you look at this, so the red line here is wages. Mine is lower, of course, but this is the growth of wages. So this is the wage that you get from EPF, the average wage growth. So on average, your wage growth 3%. Again, mine is lower. But the average wage growth is 3%. But if you look at the various asset classes, so what it means is that investing can actually outgrow the kind of wage they grow. So it's not just working hard, which doesn't apply to me too. But anyway, but it's not just that. So of course, the first one, if you're stock picking guru, you buy DBS, you would have made, I don't know, 11%, but no, assuming you're not so clever, okay. Then you just buy MSCI. I don't need to be so clever. Just buy everything. You also outperform compared to putting your money just relying on wages, because investing can grow. Of course, even STI, everybody hates it, but because we pay a lot of dividends, and there's this thing called compounding, and of course property too. But property, are you leveraging, or are you force saving? The good thing about property is that you force save, right? Because you got no choice. Otherwise the banks call you, so you have to put one side. Otherwise you would have take the money and party. I'm not saying I'm talking about other people, but the thing is also, are you getting a gain from leverage? So, but this is the Singapore index. So just something mindful for you to think about. But again, investing can really outpace the kind of wage growth that you get. Okay, I'm going on my last slide. So in conclusion, actually nobody asked me my view about ETFs, but anyway, I'll just tell you. So nobody wants to know anyway, but anyways, I'll just tell you. So for me, ETFs is a cheaper way. I mean, I worked in funds before. I worked as a fund manager before. It is definitely much cheaper. It is a very tough competitor for a lot of mutual funds, and it's almost inevitable because this is they outperform most fund managers, and they're cheaper. It's also a very disciplined approach. But again, it is always remember that this is the ultimate risk-on instrument. So what I would say that is that, let's say you take S&P, NVIDIA is roughly about 6% of the S&P index. But if most fund managers won't go on 6%, and most they hit 5%, and then compliance will be shouting at them already. So that's why technically, in a way, by default, they are almost shorting the NVIDIA because they can't buy. So it's not that the fund managers are bad, but just that there are some technicalities that limit the ability to go all in a lot of stocks. And of course, for ETFs, it's the ultimate risk on, because no cash, zero, I mean, hardly maybe 1%. So there's no cash drag, but funds, sometimes they might need some cash for redemptions and so forth. So that's why, just bear in mind, ETFs is the ultimate risk on. In the short term, we like bonds and energy. In the longer term, this one I can say, even wrong now, because nobody's going to come back in the long term, right? It can be 50 years, 20 years. But anyway, in the longer term, believe me, this is what we like. You can come back after 10 years if it's wrong. And one thing to just watch out for is, just as a disclaimer, since this is a general investment talk, is sometimes you need to hedge. Hedge means sometimes you have to take some money out of the table. Because always remember, not to sound like someone nagging you, but when you have a big loss, you get this so-called asymmetric negative compounding. I know it's a big word here. What it means is that, let's say you lose 50%, compounding is nice at what, every day goes 7%, 6%. But if you get a big drawdown of 50%, so imagine you need to double your money. It's pretty obvious, but again, you need to just double your money. So it's asymmetric. That means it's not symmetric. That means it's not like 50% down, let's go 50%, you're back on spot. So always do remember to hedge some of your risks, because if the thing looks elevated. Okay, and that's for, conclusion is for those who slept the whole time, but anyway, that's the conclusion. Okay, any thank you? I'm not sure you, yeah, okay, thanks. You're not sure any questions?
Right, thank you, Paul. All right, we have finished the second speaker, and I think what Paul has shared, I hope, has been useful for you to get some perspective onto the macros for ETF. And I think what he has shared is also quite heavy, so there's a lot of topics involved, and some of you might feel a bit tired, right, absorbing all the information. So something exciting to start the next segment, right? So I think you see this bowl I'm hugging in front of me. So you also know what this means. So if you will, please take out your bingo card. All right. Do note that you can, you must keep on to your bingo card till the end, because you will not, if you lose it, you will lose a chance of winning the grand lucky draw towards the end of the session. Okay, so for the first lucky draw, we have the Polaroid Go Gen 2, the camera that come out the camera photo directly for those that do not know. All right, and it's worth around $228. All right, and for that price, we will have our next speaker, Mr. Bruce Zhang from CSOP. All right, he's the head of fixed income, and he'll be drawing the prize for you. Right, so lucky draw time. Right, so everyone get ready, your bingo card. I try to shuffle first. Fair bit, Oh, shoot. One fly out. Okay, so he'll be drawing one. So the winner, I will staff that we're going around with a piece of paper for you to note to redeem your prize later on. All right. Okay. The first winner, I'll give you all the first hint, is a 3-digit number. The first digit, not zero, of course, I wouldn't be so funny. 3-digit number, first digit 1. Okay. Just in case you all don't know, we have 224 participants as of this lucky draw, and we have 228 already inside the venue. And thanks everyone for helping us make this a full house event. All right, the first number is 1. And then next number is 2 squared, 4. All right, 148. Is there 148 in this room today? All right, thank you. Congratulations for being the first winner. My colleague will pass you a slip of paper. Right, it's just to note that you are the first winner. So it's a 148. My colleague, please write on the paper also. 148 is the first winner. And I hope, sorry, not throwing. I forgot to take it aside. Okay, I'll keep it aside. Right, so note that after you win, you do not have a chance to win later, but you at least get a guaranteed prize now. Okay, so thank you. That is the first lucky draw. We have another lucky draw after Bruce share. All right, I'll pass the time to Mr. Bruce Young. All right, thank you. Wrong one. Okay.
Okay, congratulations again to the lucky man. Now it's time to check whether the luck is coming back to the S-REITs, because we have been talking about this topic for 2.5 years. Now, hopefully we can see some rebound for the S-REITs, because we have been discussing this topic 3 months ago through the same Philip session. So if you look at the past 2 years developments, the S-REITs still seeing a lot of headwinds, such as the high inflation, high cost, monetary tightening, or even the tight spread. But even with that environment, the S-REITs, particularly for the 6 S-REITs with Singapore exposures, they can still manage to achieve a decent rental reversions, and also the relatively good occupancy due to the limited supply. This is because even we are talking about the SGX listed S-REITs, they have some exposures beyond Singapore, but majority of their exposures are still within Singapore. And from a sector perspective, they are not only have the exposures to those cyclical names, such as the retail, office, or hotel REITs, they also have the exposure to the new economies, such as the industrial logistics, as well as the data center REITs. So they can play some offensive themes, but they can also have some defensive features over time. So how about the Singapore's economy? We have to say, but similar to our comments 3 months ago, the recovery is still bumpy, the road is still bumpy, but even until the second quarter of this year, the manufacturing PMI are still above the 50 watershed. So the economy are still in an expansion mode, and that's very important. But more important part is about the inflation. So although the speed is slow, they are gradually declining from their previous peak. So this is quietly beneficial to S-REITs. Then SGD again, it's a bit against this intuition, because when you invest in the SGD asset, you definitely prefer a strong Sing dollar versus other currencies. But it is not necessarily true to S-REITs, because particularly for those S-REITs with the international exposures, if the SGD is stronger, it means their overseas revenue, all else equal, will be lower. So from this perspective, this has impacted for those S-REITs with global exposures. But these headwinds can turn into tailwinds, particularly given that if the Fed finally start to cut and MAS also follow the similar move, then the Sing dollar can gradually be weaker, particularly for against those emerging market currencies. And if that happens, perhaps in September, then we can see the further rebound of the S-REITs, particularly for those international S-REITs with the international exposures. And once again, about the sector breakdown, we have mentioned this 3 months ago. The supply and demand dynamics, they're still relatively okay for industrial REITs, but except for the business parks. And these imbalanced supply demand already drag a bit on the occupancy part. But in terms of the rental reversions, this can be totally a different story. This is because the most of the rental contracts, they were signed during the COVID period, which typically had a discount. So now it's time to renew those contracts. So even the renew price is lower than the current spot price. They are still much higher than the previous contract price. So that's why we can continue to see a positive rental reversion for the industrial REITs. And the first quarter's data is already echoed this, because the occupancy falling a bit because of these supplies a bit more than the demand, but the rental can continue to rise on a quarterly basis, particularly for the warehouse segments. So for the rest of this year, or for the whole year, we can still expect the industrial rent to increase by a lower single-digit rate for the whole year. And data center, I think I don't need to mention that much, because the utilization rate is almost 100%, and demand is very, very strong because of this AI boom. Because the AI boom, the first beneficiaries are mainly these upstream firms, and the requirement or the request for the calculation power did benefit the data center REITs. And also, it's also important to note that Singapore, they used to restrict their supply of the data centers and only start to release some quotas or capacities in recent 1 or 2 years. So this gradually increase of the supply is just about right to meet the current strong demand. So data center are still quite okay. And moving to the next slide, for the office, we have to say this year's supply pressure is still there, particularly also including the so-called central areas, because we still have the central Bolivar Tower, not far from here, and also have some redevelopment of the Capel Towers, including the 333 North Bridge Road. But if you look at the next 2 years, the supply will be much lower. So at the time, the supply demand dynamics will further support the office rents. And also, we also see some pressures from the sectors such as technology sectors and also the Chinese firms. Their demand start to decline. But as long as there are some winners in different cycles, such as the wealth management firms or legal firms, financial firms, so there is always a demand, particularly for the city center, the CBD, grade A offices. So the demand for flight to quality, flight to green, and the relocation cost concerns, they still benefit the S-REIT retention ratios, particularly for those grade A offices. And this is particularly true for S-REITs, as compared to those US, UK, Australian offices. Even these days, some of the employers, they are less keen on this work from home arrangement. For those countries, there are still a high ratio for the work from home the initiatives. So from this perspective, S-REITs or S-REIT office REITs, they're still in a relatively good position for now. For retail, it's very interesting because at the beginning of the year, when we observe these retail sales trends, we see the retail sales price rebounded, reflecting the inflation change. But the shopper traffic or the foot, they are not quite strong, which means the sales volume is not that strong. But if you look at recent months, even the retail sales, the shopper traffic that start to recover, and thanks to those the returning tourists, and that's why the downtown malls are seeing an even stronger performance than the suburban malls are in recent years. And we believe this continuing tourism recovery, also boosted by this strong pipeline of the MICE events and also the concerts, almost every month, and this will continue to support the downtown retail sectors. And these are also echoed by the first quarter's results because the top line growth are still quite good. And on a forward-looking basis, we can still see a positive middle to single the rental reversions for this year, and also thanks to this high occupancy rate for the malls, which is over 90%. And in addition to that, we also see the malls are still doing something new, the AEIs. For example, they can leverage the unlocked gross floor areas and also conduct some tenant mixing efforts to further bring in a stronger and trending brands. These can bring in a more organic growth. Even the M&A growth is not quite strong at the current stage. And that's also, again, to explain why the CBD leasing is still quite strong because of these back to office crowds together with the tourism recovery. And very similar to these industrial rates, the retail rental reversion, they also have three-year leases, which were signed 3 years ago. Now they are renewing their contracts, so their rents can definitely be higher or inflating versus the previous years. Tourism, quite clear. I don't want to repeat the numbers. So the first round of the reopening in Singapore happened in 2 years ago, but at the time, it's mainly from the global investors, also including the regional travelers. But this round, particularly for this quarter, we did see the Chinese tourists coming back. Because of the visa-free treatment, not only by Singapore, but also by Malaysia and Thailand, more and more Chinese tourists, they can come here through the so-called free travel or even through this group travel. If you look, you have time to go to the most popular attractions in Singapore, you can see, you can hear more and more native Mandarin speakers like myself. So sometimes they come back, like let's say 3-4 people, and sometimes they can also take a group travel, like the summer camp vacation travel. So that's very important to support the hotel rates this year. So even at the beginning of this year, the RevPAR already start to slow a bit because of the high base effect and the ease of these so-called the revenge spending or revenge travel. Now we are still quite confident about the whole hotel sectors, and this is already echoed by the recent room rates or RevPAR growth. And occupancy growth are still lag a bit, but it is not surprising. But we should bear in mind that the supply, maybe back to the previous slide, the supply, because of the COVID impact, the supply is very, very limited in the upcoming years. And demand can still be driven by the Chinese tourists. So the hotel rates should still have a good position in the next couple of months at least. And this one, we already mentioned this 3 months ago, when the S-REITs, they conduct their outlook for the rental reversion for this year, they are still quite constructive. Even they can be moderate from last year. the total, the absolute number of the growth can still be at least middle to low single digit growth for this year. And this has been echoed by the first quarter's results. We did see a quite constructive positive rental reversions, and for the yield are still quite attractive, at still more than 6% like our product. But the valuation, even despite the recent rally in early July, the PB is still within the 0.8 to 0.9 range. So that's a very attractive level for S-REITs. And for the spread, I have to say it's still a bit tight at the current stage, but it's not because of the yield is low. It's simply because of the risk-free rate. The Singapore, let's say the Singapore 10-year yield is high. But once the Fed start to cut and once the MAS start to follow, then the risk-free rate will finally go down. Then it's a very good time to capture this widening spread and reinvest into the S-REIT sector. And also the operating cost used to be a concern for the daily operations of the S-REIT managers, but now the wage growth a bit easing, not great to us, but great to the S-REIT performance. And also the labor market is light tightening. But more importantly, the average the inflation, including the electricity price, they start to go down. And even without this, the S-REITs, particularly for those leading S-REITs, they have a pricing power to pass these costs through and to the end users. So from this perspective, see, the cost is no longer a concern for the S-REITs, at least for most large and mid S-REITs. And again, we are talking about the interest rate impact every time. It's definitely one of the biggest drag in the past for S-REITs. That's also explained over the past 2 years. Even we have a decent yield, the S-REIT price are still going down. But now these drag can be the key driver because if without this concern, then the borrowing cost will be lower, and also the discount rate will be more favorable to the S-REITs. And just like we saw in early July, the S-REITs finally rebound 5 to 6% for the whole month because now market pricing in the first rate cut from the Fed will happen in September. And thanks to this high for longer environment for the past 2 years, the borrowing cost has already expanded by more than 1% for S-REITs. But for this year, we think the turning point will finally coming because the S-REITs now are expected that their borrowing cost are expected to rise to another 0 to 50 bips, and then they will peak. Then the implication here is that even the Fed is not going to cut or just cut once, the funding cost it will anyway peak. So the downside, the biggest downside for S-REIT will be gone soon. And to echo this point, the first quarter for this year, the S-REIT's borrowing cost has already increased by up to 60 bips. So from this perspective, the increase of their funding cost will be finally slow down or even increase next year. So investors should or can position in S-REITs ahead of a change in this funding cost. And this is a chart we recently plot. If we try to learn from the historical experience, investors should invest in S-REITs ahead of the rate cut. And taking the last round of the rate cut cycle in 2019, then actually, if you can invest in the S-REITs 6 months ago, or even 9 months ago ahead of the rate cut, and your forward 12 months return will be the highest, like even more than 20%. And now that the market expects the first rate cut in September, it's quite a good time to reinvest into this sector. Or even if the Fed can postpone its rate cut to December, now is still a good time to invest in the S-REIT sector. And despite these high interest rate in the past few years, the total gearing for the S-REITs are still quite okay. And another good news that MAS most recently also raised their leverage limit for S-REITs from 45% to 50%. So this can leave more room for the current S-REITs to develop their existing projects. And even with this previous gearing limit or the ICR limit, the most S-REITs still have some revaluation buffers before reaching this previous 45% gearing. But now that the gearing is 50%, I think for those names with small buffer, now their buffer definitely become larger. And in addition to the leverage limits, the ICR ratio also loosened, because in the past they request 2.5 interest rate coverage ratio, but now it's lower to 1.5 multiple. So I don't think this means that there will be more bad quality S-REITs on SGX. It's just they just released a bit, because in the past the requirement is too high. Now it's just be more in line with the global standard. So investors should have no concerns about this relaxation. And again, the asset spread, the yield spread for the office retail industry, that's still quite okay, but office continues to see some negative spread, so still under some pressure for now. But the good part is that a lot of headwinds are pretty much gone for now. Inflation started cooling down, costs start to decline. Even the monetary tightening is behind us. Borrowing cost maybe still have a few 10, 20 bips to go for the rest of the year, but it's almost peaking at the current stage. So all the headwinds now is turning to tailwinds for the S-REITs, particularly for the rest months of this year. And valuation, I mentioned a little bit. Again, why we are saying that the spread is fair? This is simply because the dark blue line is too high for now. Because if you look at the yield at the bottom, the yield is quite attractive. So even we think the spread for now is tight, the current spread is still fair, relatively fair. And if you plot this spread and yield scatter plot chart, they are still quite in line with the historical average. But more importantly, every time when the S-REITs fall back to this range, we see a very strong support for PB, 0.8, 0.85. For example, July, we already see a rebound which used to push the PB back to over 0.9, but still below 1. But now after recent corrections, it's back to the range near to 0.85. So investor can reconsider investing in S-REITs ahead of the September rate cut, if any. And this way is very important, not only because this is our products, also linked to your bingo card. So highlight those key information. So our CSOP IH S-REIT Leaders Index ETF, the tickers are SRT and SRU. SRT is the single dollar counter, which most investors typically use. And if you investors have some US dollar at hand, you can use the SRU. And our AUM, it's $70 million. And since inception, we managed to maintain a relatively stable AUM, because although the price is going down, but the dividend, we tend to pay a dividend annualized more than 6% over time over the past nearly 3 years. And for the investor to access these products, the starting size is just 1 unit, which is less than 10 Sing dollars. So it's very easy to access. And more importantly, we pay the dividend semi-annually. And our most recent payment or the ex-dividend date just passed the most recent dividend date, which is July 19th. But investors should have no worries, because the next round of the gain will not from the dividend, because we already paid. The next round of the gains will come from the capital gains once the Fed start to cut. So that's very important. And these are EIP product. We have TER 0.6% capped. That's very important, which means regardless of the size, our fees will be capped at 0.6%. But the good part is that for the S-REIT, we also track the SGX, the SGX index, the SGX S-REIT Leaders Index, which means we are not only include the largest S-REITs, but also include the most liquid S-REITs. I think this is very important at the current market cycle, because the large cap bias, which means we can provide some defensive features when the market during the market downturn. But once the market is going to start to rebound, their beta, their liquidity could actually the best suit to capture the potential rebound for now. So that's why we think it's a good time to reaccess this sector. And our sector breakdown is actually a result of this market cap and liquidity screening. So we don't start from the sector allocation, but rather through the market cap and liquidity screening, it's a result of our screening. And in addition to the single exposure, we also have a lot of APAC and global exposure. So for every single investors in Singapore, out of Singapore, as long as you use the SGX listed S-REIT ETF, you can still access the international projects or growth opportunities, but your withholding tax will anyway be 0. So I think that's why we can use S-REIT to access the APAC and global opportunities. And since inception, we outperform the benchmark by more than 60 bips, which means we outperform the whole annualized TER. So even after deducting the fees, we can still slightly better than our benchmark. I think that's very important to investors. And from absolute return perspective, it looks like ugly, but now it's quite really the right time, because now the S-REIT level is not far from their historical maximum drawdown, but is far from their previous peak. And in July, they already, because this performance as of end of June, but in July, they already rebound by 5 or 6%, and then corrected a little bit in recent week. But now they still have a lot of room to in terms of the further rebound, particularly during the period between now and the first rate cut in September. So now it's a good time. So the more decline you see on a daily basis, the more confident I can recommend you to reinvest into SRT. And the last slide is just our top 10 holdings. We don't mind to disclosing this because we are quite transparent. Those our top 30, our full holdings is actually available to investors on a daily basis on our website or Bloomberg if you use Bloomberg. Why we are comfortable to disclose this? Because investor can definitely directly invest in any of the underlying S-REITs as long as you have a high conviction. But investors should also be aware of the concentration risk and the drawdown risk, just investing in a few names of these underlying REITs. And comparatively, the ETF vehicle can definitely provide a diversified universe for investors to capture decent yield, like more than 6%, but can still control the volatility at around 15%. So that's very important. And also, even investors can create their own basket, let's say using a 4,000 Sing dollar, then it's still not a very small amount. And for an ETF vehicle, it's just less than 10 Sing dollar. And more importantly, from a trading perspective, if you go to the SGX to trade those REITs, of course, some are still quite liquid, which means you can still get a very tight beta spread. But through our dedicated institutional trading desk, we can achieve a very, very low trading cost through our trading desk. And we can transit this saving to the ETF pricing and benefit all the S-REIT ETF investors. And that's why we think now is a good time to go back to S-REIT, particularly for ETF vehicle. And that's all for my sharing today. Yeah, thanks.
Thank you, Bruce, for the sharing on Yeah. So thank you, Bruce, for the sharing on S-REITs. I hope that helps to give you some flavor of what is to expect for S-REITs itself, and performance to be maybe some rebound there, hopefully. Okay, so for the next one, you'll be the finance speaker before your lunch time. All right, so before lunch, you hit your finance speaker. And just a reminder, I was informed to let you know, please do not rub your lucky number. Sometimes you like rub number, the lucky, right? You rub already, the number will disappear. Then you no more lucky because cannot claim. Okay, so please do not rub the lucky number. And if you find that your number is fading, do let our colleagues know outside before it really fades finish. Because if it fades finish, then cannot claim already. Okay, just to take note on that. Okay, so just aside, the next, sorry, did I press too fast? My lucky draw, yes, correct. So the next one will be the next lucky draw will be by Mr. Lim Eugene, who is the Deputy Head of the Asia ETF Business Development for Nikko AM. All right, so we'll invite him on stage to do the lucky pick. All right, and hope all the best for all of y'all. This lucky draw prize number 2 is a Fitbit Lux Fitness Tracker worth $168. And he has already chosen the number. All right, this time round, wow, this number, I can say quite lucky, because it's just added not long. 3 digits starting from 2. All right, just now I said we have 224, right? Just now 224. as of what I was informed when we came in, it was 242. And this number is actually between the two numbers. So it's a 236. And based on this number, I will expect that it's not in this room, right? Because for the information, this room is already full house, and we have opened up the academy room on the other side. 236, my colleagues, another room, please assist to check whether it's in the spillover room. All right, so in case you somehow find it too compact here, outside is also, the next academy room is also full. We are also screening this session at the SGX IPO, the arena area, the big stage area. Right, so if you go toilet, come back, you can still see on the screen. Okay. No, okay, cannot find. Okay, I give the person 5 seconds more. 236. Look at your lucky draw. Maybe you're also inside here for some reason. 236. Last call 5 times. If I don't see it, we will take a next number. Okay, he found the person. Sorry, So, but don't worry. You will never till now means you have chance for the grand lucky draw. Right now, always think of the better, right? Think of the better. So, without further ado, let me pass the time now to Eugene, who will share more about the fixed income investing. Just now was S-Street, now fixed income investing amidst the volatility. All right, please give a welcome to Eugene. Sorry.
Thank you. Thank you for the kind introduction. Thank you everyone for coming to SGX, filling up the auditorium. Right, it's very nice to see that it's a full house today, especially on a Saturday. And I know I'm standing in between yourselves and lunch, so I'll try to keep this interesting. I'll try to keep this educational. And I hope that at the end of my short presentation, you would, if you need a refresher on fixed income as an asset class, why bonds in a wrapper like an ETF could be useful for you in your investing journey and in your portfolio, then I would be very happy. Okay. So I'm the deputy head of the Asia ETF business development team here in Asia. One of the questions on Bingo asks, how many fixed income ETFs or bond ETFs does Nikko AM have listed on the SGX? The answer is 3, right? So we have got a Singapore government bond index fund. We have got a investment grade corporate bond ETF. The last one that is, the lesser known brother of these two is a China bond ETF. But today I only have time to speak about the 2 Sing dollar denominated bond ETFs. Why is this interesting? Why did I single out the Sing dollars? Well, it's really because the Sing dollar has shown, resilience and strength, and also the reason why Singaporeans like to travel, right? Really because of the currency. But aside from, the strong currency that these two funds are denominated in, why do people like fixed income as an asset class? Okay, I've listed 3 reasons here. There are probably more, but I think these are the 3 reasons that I want to share with you today. Income generation. So bonds, if you invest in a single bond, you do know that you will always have income, coupon payments regularly. It's either usually semi-annually, twice a year, sometimes once a year. But coupon payments are a big feature of bonds. And at the end of the bond maturity, whether it's 2 years, 5 years, 10 years, you do get your principal investment back. Portfolio protection. If, theoretically speaking, if let's say that there's volatility in the markets and there's a drawdown in your investments, if you lose 50% of your investments, that means that just to get back to where you started at 50% down, it means over the next period, whether it's 1 year, 5 years, depending on your time horizon, that investment has to climb back up twice, right? Double. So portfolio protection is, in my opinion, almost as important as growth potential, right? Because if you look, volatility may not be something that all investors can stomach, right? So fixed income, generally speaking, they are counter-cyclical to the equity markets. Correlation between, traditionally, between fixed income asset classes and equity is, there's very little correlation. So that gives you inherent portfolio protection. It acts as a dampener of sorts against, drawdowns and risks. Lastly, diversification. It's related to the first point, right? Diversification away from equities. If your entire portfolio is equity-based, that's all right, that's okay, but diversification is the free lunch, so to speak, right, in investing, right? So if you have got equities, you can diversify it into what my friend Bruce talked about, REITs, markets, for various reasons, and then you can diversify it further by considering bond ETFs or bonds as an asset class. Now, this is the Singapore dollar fixed income market. So I share this quite often. Just to give you a bit of history, back in 2018, right, when the MES and Nikko AM, we launched the Sing Dollar investment grade index as well as the ETF. And this was really the plan was to allow investors, retail investors in Singapore, to get access in relatively bite-sized amounts to fixed income as an asset class. Because in the wholesale market, if you wanted to buy a single bond, the minimum investment size, the first clip, would be around usually about 200,000 to 250,000, which may not be accessible to the man on the street in Singapore, right? I don't have $250,000 in Sing, actually in most currencies, right, lying around, right? But now with an ETF, with the help of MAS and Nikko AM together, right, we've got an ETF. Today, you can get access to the fixed income market for as little as $1, right, which is roughly the price of where the bond ETFs are trading today. Okay, so that's without your trading costs. But even if you've got $2, right, you can get exposure to the fixed income market. That's how easy it is. You do not need $250, right? Okay, so now this is just a bit of history. Why Nikko AM and why we are in this game. This is just a matrix between risk and return. So there's no free lunch. If you want more returns, if you expect more returns, you're taking on more risk, which is what this graph is showing. All the way on the top right-hand corner, that's the high yield bond space. I'm not going to really touch on it, but I think the poster boy for, well, not great reasons would be maybe the China property market. Bonds issued by China property developers. You've heard of names like Country Garden, Evergrande. They were close to default. Bonds that were trading at par value, so about $100. Currently, they're trading at about $30 or 30 cents to the dollar, right? But that's the kind of risk and return matrix that these bonds occupy, because they were giving you, well, relatively good yields, right? Maybe 13, 14%. But then you take on a lot of risk. One day, if that issuer defaults or it's close to default, an investment that was $1 would have dropped to 25 to 30 cents, almost overnight, right? So we are not in that spectrum. So we are in the really safe, maybe a bit boring part of the spectrum, which is where the Singapore government bonds lie. You do know that Singapore government, we still maintain a AAA rated rating, which means this is as safe as any investment is likely to get in the bond universe, right? I don't think, no other country issuer in Asia has got AAA rating. Only the Singapore government bonds, right? And they have maintained this for the last 25 years. So over the great global financial crisis, over the Asian financial crisis, they have been able to maintain this rating. So it's very safe. However, you do get, right, the requisite returns, which is a little bit lower. Now moving up a little bit, we've got the investment grade corporate bond space. I've got a chart. Just want to show this to you. This is where this is credit rating, which is important when you analyze bonds, right? At which part of this spectrum, in terms of risk, are you investing in? Near the top would be AAA, so that's where the Singapore government bonds lie. Investment grade, so the other section of the market that I was talking about, investment grade corporate bonds, that's somewhere in the middle, AAA. But even if you have, a portfolio of bonds that are in the BBB space, right, that's in the middle, in the blue space, that's still considered investment grade. Why investment grade? It just means that, relatively speaking, they are able to stomach out more volatility. They are good for their money, so to speak. If you lend this issuer money, at the end of the period, whether it's 5 years, 10 years, you should be able to get your money back. And they are able to repay your coupon payments every semi-annually, every 6 months or a year. It gets a bit hairy right at the bottom. So if if your bond investments are all rated CCC, CC, D means default, right? They cannot pay your coupon payments when it's due, or they're not able to give you back your principal at maturity. This is where, as I said, things get quite hairy, and then there are liquidation or bankruptcy proceedings around that. Right? But we're going to focus on the investment grade spectrum today. I promised that I'll try to give you a bit more information about the fixed income asset class. Do people, if you understand yields, then there's the concept of credit spreads, which just means that for more risk that you're taking, more credit risk that you're taking, you need to be rewarded with more returns. So Singapore government bonds are usually seen in the Singapore dollar bond market as the risk-free rate, right? And that's denoted in the light blue line at the bottom. So you can see roughly Singapore government 5-year bonds, right? They have been giving you, anything from 2%, close to maybe 4% recently in 2022, and it's still hovering around 3.5% to 3.7% as of May or June this year, right? So that's considered the risk-free rate, right? If you lend money to the Singapore government, after 5 years, you get, your 2-3% yield, and at the end of the day, you get back your principal in full, and it's almost risk-free, right? If they don't pay you back your principal, we as Singaporeans, we've got much bigger problems than our investments, right? But then now if you lend to DBS, so if you invest in DBS bond, or you invest in any other bond that is in the investment grade corporate bond ETF, for example, it could be DBS, OCBC, it could be Temasek, for example. Are they as creditworthy as the Singapore government? Well, the answer is no, right? And how much less creditworthy are they, right? In this chart, it shows you that they are 100 basis points less creditworthy. That means for the same amount of borrowing, right, they need to pay you a bit more in terms of your returns, which is about 100 basis points. And that's a credit spread. So between the risk-free rate and credit, right, investment grade credit in Singapore, you're getting 100 basis points more per annum, right, per year for taking on that credit risk. So this is what this chart is talking about. Same data, just in a different manner, right? I just take the yields on the investment grade space minus the risk-free rate. This is the spread, right? It's not kaya, butter, toast spread, right? This is credit spread. Yeah, you can see that it spikes, right? Why does it spike? So the first spike here on the left-hand side, can you see that it spiked all the way up to 200? That means the risk that investors are demanding from the investment grade issuers doubled from, okay, I can take on credit risk for 100 basis points. Suddenly in March 2020, we're demanding a credit spread of 200 basis points. What happened then? Yeah, COVID, right? I still see some audience members wearing masks, right? Really since March 2020. And why? Because volatility in the market, right? And what happens when, right, credit spreads go all the way up. And then similarly, in October 2022-23, so 2022-23, you can see that there's been a spike and now it's steadily coming down. So this is not COVID, but this is another phenomenon, which is inflation. Central banks trying to fight inflation, they raise borrowing costs. So what is this trend when credit spreads go all the way up, when yields go all the way up, what happens to price? That's really the next bit of education that I'm trying to share here. Right, this is the inverse relationship between price and yield when it comes to bonds. So when credit spreads shoot all the way up, what happened to bonds? You as a bond investor, if you held some bonds, you probably wouldn't have been too happy because right, interest rates go all the way up, prices swing all the way down. How sensitive is that swing? Is measured by this measure called duration in years. So just a rule of thumb, because of this inverse relationship, if interest rates go up by 1% and duration, I'll just use an example. Let's say duration is 5. Interest rates go up by 1%, price of your investment with duration of 5 will swing down by 5%. Okay? Right, so you can think about it, if the duration measure is very long, 10 years, any small movements in interest rates would have a much bigger swing in price. So it was painful, right? As a fixed income investor, when inflation was high, central banks were trying to rein in inflation by raising interest rates. Right, but it's not all doom and gloom. The good news is that do we think we are at the end of this rate hike cycle? Generally, yes. Right? Or that's our hope. Okay, we've been waiting for since the start of this year. The Fed has pushed back expectations, but I think now the signs are quite close, right? That maybe by the end of the year we'll see at least 1 or 2 drop in rate cuts. Okay, so that's the potential capital appreciation the US bond investor might have. But even then, just moving back to this. If you're a new investor, if you've not had any exposure to bonds and you happen to look at these charts, right, sometime in, let's say, January 2023, where the spreads were almost 200 basis points. Would that have been a good time to invest in bonds? Generally, yes, right? Because you would have locked in these yields. So prices would have been depressed, the yields would have been high, and we've not seen this kind of yields for a very long time. I've got another chart to show to share later, right? But this is the concept of when we say lock-in yields. Sometimes you read articles written by us, other asset managers, your advisors may say, this is a good time to lock in yield, right? It's really because of this almost once in a generation kind of movement in interest rates. This is just a mathematical example of the inverse relationship between price and bonds. Price and yield of bonds. I won't spend too much time on it, right? Because now I want to go to, I've talked about fixed income as an asset class, it's really about bonds, but why bond ETFs? So in ETF circles, we always say don't put all your eggs in one basket. Yeah, have some vegetables. When you're having lunch later, do have a balanced meal. So same concept applies for investments, right? So this picture shows 2 things. One, diversify away from equity. If it's you're wholly concentrated in equity, diversify. You can look at REITs as an asset class. You can look at fixed income. But even within fixed income, do you just buy one bond? Right. The reason why, I think once again going back to history, why MAS and NICOM decided to launch investment grade corporate bond ETF, right, is because we want to break it down for investors, retail investors, right? Instead of putting $250,000 in just one bond, one asset, one single bond, one single issue, one single maturity, right? Get an exposure to a whole spectrum of issuers. Okay. Now this is a lot of words, right? The market outlook. I'll just summarize what we at NICOM with our portfolio managers think the market outlook would be like for the rest of the year. So there might be some volatility in the near term, right? As we close out the year, I don't believe it's almost August. So I think there's always going to be debates, right? Rate cuts, rate hike, inflation data comes out, unemployment data comes out, and we should expect some volatility, right? But nevertheless, we still believe that directionally global bond yields are coming down, and that's what we're looking forward to by the end of the year. Corporate bond yields have declined from the peak. I'll show a chart later, but they still remain attractive on a historical basis. It's still healthily high even as far back as 20 years. So once again, it's almost a once in a generation kind of opportunity to, what you shared just now, lock in some yields. The credit spreads have been resilient, right? Remember, it's about 100 to about 200. Now it's stabilized to about 100 again, right? And think about these credit spreads as a buffer against any short-term volatility in the interest rates. Okay, so I think it's still a good time to get some exposure to fixed income. If you don't have exposure there, diversify. It's always diversifying your investments is always a good thing. And so do consider fixed income, adding fixed income to your portfolio. Okay, there are some risks, right? So if inflation continues to be very sticky, or any kind of geopolitical risks, especially with some big elections coming in the US in November, those are just some risks you should be considering. This is just a short summary of the kinds of bonds you get exposure to in the two ETFs that I talked about. So on the left-hand side, this is the ABF, so AAA rated. Singapore government issues about 80%. SGS, Singapore government bonds, take up about 80% of the ETF. If you buy into the ETF, 80% of the portfolio is in AAA rated, very safe Singapore government bonds. Not to say that the other two, HDB and LT, is not safe, right? There's a reason why they're called quasi-sovereign bonds. Quasi-sovereign just means like sovereign bonds. Are they sovereign bonds? Are they Singapore government? Not quite, but still considered very safe. Then on the other end, investment grade. So what justifies the 100 basis points or almost 200 basis points additional spread that you get investing in bonds issued by banks, statutory bonds, insurance companies, REITs, etc., etc. So still quite heavily weighted in banks, bonds issued by banks. So you've got DBS, OCBC, UOB. The usual suspects, but also foreign banks. Foreign banks issuing in Sing dollars, you can get exposure to them as well. Some banks might be, let's say, Macquarie, ANZ, they do issue in Sing dollars once in a while. Now, duration, I think it's in your one of the questions in the bingo game. So once again, sensitivity to interest rates. The ABF is about 7.7 years as a measure. Investment grade corporate bond, 5.6 years. So if interest rates, once again, why is this important? If interest rates start to come down, longer duration means that the swing upward would be more pronounced, right? So in terms of quantum, it's about 7.6 times more pronounced, right? Versus something with a duration of 1. Okay. So yeah, we mentioned that on a historical basis, the yields are quite attractive. And I hope this chart on the top shows why we think it's attractive from a historical basis. So we stretch the data back all the way to 2013. So roughly 10, 11 years of history. Right, so this basket of this index, which comprises of a basket of Singapore government bonds mainly, is currently yielding at about 3.13%. And if we looking at the data 10 years ago, it has never been so high. Right, it peaked at about 3.5, 3.7%. Right, but still, if you've not you're not lucky enough to get locking your yields at 3.5%, at 3.13% is still pretty attractive, considering the AAA rated ratings of these bonds. I'm going to try to use the laser pointer here. No laser. But what I do want to share here is that 2021, 2022, when central banks were going on this rate hike cycle, you can see the bonds did not do well. You can see in 2022, it was down 6.4%. Not great for bond investors, not great for me as a business development manager talking about bonds, right? But the thing is that once the rate cycle started to peak, once the expectations that rates would start to come down, what happened the next year? You could see a rebound, sort of 4.4%, right? You may ask, why did they do well in 2020? Right, because of COVID. So there was investment grade, Singapore government bonds as an asset class safe haven. That's why it did well, right? It does the best whenever there's a lot of uncertainty in the market. Equity markets were hammered, right? Bond markets, safe haven asset classes like this did very well. Similar story for the investment grade sector. So 3.7, you can see, well, back in 2013, 2014, yeah, it hit about 4. So it's a similar story, but not as pronounced as the ABF. And you can see that the peak happened sometime in 2022, going to 2023, and then it steadily started to come down. So yields have started to come down. Still not too late. The window, I don't think it's entirely closed yet because, right, 3.7. But if you had locked in your yields at 4.5%, almost 5%, and yields have started to come down, as this chart shows, what happens to your investment? The returns have done very well. I would say it's quite amazing here. When I did this chart, right, at the end of 2023, 8.6% returns over 1 year, just because of rate cut expectations, right? So it did exactly what this asset class was supposed to do, exactly what we expected it to do. I was just pleasantly surprised that, it shows so clearly, right? Will it continue to come down? I think generally, yes. We are expecting further rate cuts, right? Debt continues to strengthen, right? And if rate cuts do continue to go, right, I think 2024, the returns could be quite attractive by the end of the year. Okay? And what's also good about the investment grade corporate bond sector is that, once again, remember there's some buffer, the credit spreads. So even if there is some short-term volatility, even if there are some fears that the rate cuts may not be coming so early, right? Yields go up a little bit. At least you still have about 100 basis points worth of buffer that you get from the credit spreads, and then you're not taking on that much risk as well. You're still safely within, right? Remember, the credit spread spectrum is safely within the investment grade part of the spectrum. Yeah. So this is just a summary, right? Just 3 points. Generally speaking, interest rates have significantly adjusted from the low levels, relatively attractive from a historical basis. So I've given you 10 years of data. ABF and investment grade corporate bonds still relatively attractive. Corporate bonds, remember, because of the spread, right, gives you some kind of buffer against short-term to medium-term volatility when it comes to yield, right, as the markets debate the actual timing of the rate cuts. Okay, and then lastly, this is, if, let's say, the war in Ukraine, just is touch wood, let's say, or there's another, some other conflict that just explodes across the world, which asset class did better, right, during the COVID crisis, right? That's the Singapore government bond asset class. That part of the spectrum did better, right? So if you expect some volatility, then go for the safe haven assets, which is represented by the ABF ETF. But if you want steady yields, some credit spreads, right, to help you buffer against short-term volatility, then maybe the investment grade corporate bond ETF is slightly better for you. But if you're very bullish that interest rates are going to come down and you want to get a bigger swing upwards, which one should you go for? You should go for the one with the greater duration, which is the ABF. Okay, so that's how I hope that with this information, the backdrop and the sharing that I had over the last 20 minutes now, right? If you do see volatility in the market, that's not something to be afraid of. Now you're better educated, you're better able to make your investment decisions, whether you want to add more duration, you want to pull back on duration, you want to get out of fixed income entirely, or you want to balance your portfolio as necessary, right? So it's not something that there's an easy decision to make, but I think with more education, with more familiarity with fixed income concepts that I shared today, credit risk, credit ratings, duration, this will help you in the decision-making process and help you get a more robust portfolio, okay, for whatever investment needs you might have, whether it's paying for your children's school fees in the future, for a retirement, or maybe even a holiday at the end of the year. Okay, thank you so much. Yeah, thank you so much for your time. Hope it was helpful.
Right, thank you, Eugene. Okay, so before you leave, I know some of you are rushing off already. Before you leave for lunch, I got some important announcements for you. All right, so not to worry, there's definitely enough food for everybody. Right, we ordered a lot, don't worry. Right, so don't rush out. Listen to the important announcements. All right, so in case you're not aware, just inform again. The information that the issuers are sharing are also relevant to the Kahoot quiz if you want a chance of winning the prizes, because not everyone will win lucky draw, right? But Kahoot is something that you can work on to win on your effort. So do listen to some segments that they say is important. Second thing is that for lunch outside, it's only designated to certain zones. So when you collect the food, do only eat in those zones and do not eat on the carpeted zones. All right. So there's they will actually direct you. My colleagues will direct you. Okay. Another one is lunchtime will be. Sorry. Lunchtime, the duration will be until 1:30. 1:30. But try to note that because there might not be enough sitting for everyone to eat together. Right. If you're waiting for your seat, you can go engage the booth. There is only 25 winners for the PM bingo card session. Right, it already was fully redeemed in the AM. PM have 25. You must go to the Philips booth to redeem. The first 25 for PM will get it only. All right. If you finish eating, do stand up. Let the next person sit down to eat. You can come in first to rest or to take a break to continue. All right. So I'd like to thank everyone for joining us this AM session, and I'll see you all for the PM session. Right. Do take care and have a nice lunch ahead. Thank you. And for the Zoom attendees, please note we'll be resuming at 1:30 or slightly more than 1:30. So do have a great lunch ahead as well. Thank you.
Been crying, no, there's just smoke in my eyes.
Also, because there was no Q&A session, and there will no be Q&A sessions except for a short one for the panelists. If you have any questions for the ETF issuers, do engage them at the booth. They are there during the lunchtime break as well as post-event. They will be there for some time. So do engage the booth and the ETF issuers or the Philips booth. As well as we do have our Philip promotion for the share builder plan. All right, for the regular savings plan for Philips, right? Just find out more about the current promotion for the physical attendees. You can get a chance to get direct vouchers if you actually sign up for our regular savings plan for Philips Securities. All right, and one last thing is we do have colleagues outside there. They are serving you food. Some of them are actually our advisors from Philips Securities. They are also here because they can share with you how you can actually get an ETF portfolio. All right, so you can actually get an ETF portfolio investment, and then you will actually get to find out more with them on how they can advise you for it. Right, so if you're already still lost of what to invest in, with so many ETF, right? Do engage our colleagues out there to find out more about ETF advisory portfolio that they can provide for you. Right, so those colleagues are actually serving your food now as well. All right, so do engage them later after your lunch. Thank you.
Cause if you don't want me, then you're not the one. The lights are shining like the sun out tonight. Just keep your body moving how I like. Oh yeah, the music feels a paradise. Can't get any better, no. I wanna stay right in this moment for life. Baby, treat me wrong, treat me right.
then proof that 去排队是有用。再回来。
All right. Thanks everyone for queuing up for your lunch. All right. I'm informed that the queue for the NTUC voucher for the bingo card is already at 25. So if you're not yet in a queue of 25, then you might not get it by your turn. All right. So I think they are already fully redeemed. They're just queuing up for the redemption of the bingo card. All right, so no more bingo card NTUC voucher, but you can still find out more about the answers with the issuers for your knowledge. All right, while you're queuing for your lunch as well, there's also the coffee. All right, until 2 p.m. You can also get some coffee. All right, and we do have still the SBP Share Builder Plan promotion, along which is called the regular savings plan. You can find out more at the issuers the Philip booth and the issuer table on the different ETF available. All right. So